All right, we should be live. Hello, everyone. Welcome back to another monthly installment of the Mogul webinar. You have Joey Gumatato here, co-founder and COO of Mogul. And actually today joining me is Michael Cazales, my director of real estate. So super excited to have him on. Alex is actually up in NYC, crushing some incredible PR engagements, was on Yahoo Finance with an incredible segment that we can share and we've shared on our social medias. So go check that out. Very, very cool segment. And you did a great job. Shout out to Alex there. But Michael, welcome back. Great to have
Thanks.
you.
Yeah, thanks. Obviously, I'm not Alex Blackwood, but I think we probably both can go through his normal script of I was at GS, took a garden leave, sweat stained notebook, met Joey at a diner. He didn't call me crazy. But yeah, no,
That's just so
to be
spot
back
on.
on. Yeah, I was on whenever we were filming from the Alcaraz down in Lozella, Georgia. I'm not sure if anyone could hear what I was saying during that. The audio was a little rough, but I am the director of real estate here in Mogul. I started at Mogul last July, kind of straddling the demand and supply side. Made the full switch to the supply side with Joey in July of this year. And yeah, kind of my role is heading up acquisitions, making partnerships in these different markets that can with folks that can feed us some solid supply, and also managing the existing portfolio of assets that we have. But yeah, thanks Alex for taking the trip to NYC so I can join this month.
Heck yeah, it'll be super exciting. We can focus on the real estate, about what's going on in the market. I can give long spiels that no one wants to hear about the math, and then we can move on. Yeah, so I know lots of going on in the world right now. You know, lots of major headlines this month. Nvidia released incredible earnings that were kind of propping up the market, but ultimately it's very volatile out there right now in the public equity sector. I think a lot of mixed signals, both from institutional side and from retail investors alike. Lots of concerns about bubbles forming, lots of speculation about the recent jobs report that was delayed and released, which surprisingly was actually pretty solid. What does that mean for potential rate cuts, right? I think a lot of analysts are saying that there could even be one or two more cuts toward the end of this year or early next year, probably in increments of 25 bips, I would probably guess. But super exciting stuff in terms of what that does for the real estate investor cost basis, right? What that does for the market in terms of buyer opportunity, and what that could do to ultimately also help facilitate more demand sentiment kind of in the market around both rents and buying properties, and whether it's first-time home investors or continued second, third time real estate investors, or even seasoned investors and institutional investors. I think ultimately investors want to see those rates coming down, and that, you know, directly translates to lower cost of capital, lower cost of borrowing for us, better terms on our debt service and the loans that we take out on every property, and then ultimately better cash on cash yields for every investor on our platform. So Michael, yeah, what does that kind of mean for the real estate, the Mogul real estate investment, right? Kind of double clicking in on single family rental investments, short-term rentals, mid-term rentals, long-term rentals, even potentially. Like, what does kind of the shift away from public equities back into you know, tangible private assets, like, you know, controllable real estate investments, private equity investments, like those available on the Mogul platform? Kind of what do these lowered rates, this kind of return from the public equity sector into the real estate sector mean for us as investors?
Yeah, absolutely. I mean, with lower rates, that's obviously beneficial as a real estate investor. That's less of the monthly cash flow that has to go to the bank. So obviously that's great. But what it also does for Mogul specifically is open up the business plans that we can attack. To date, we've been Airbnbs and pad splits, the midterm, short-term rentals. But as these rates start creeping down, it gives us opportunity to really attack the long-term rentals, mainly on a multifamily side, but small multifamily, you know, the 4 to 10 units. And we've made a lot of headway with lending partnerships where we're going to be getting standard DSCR rates and terms on the LTV side up to 10 units on multifamily. So that completely breaks the doors wide open onto a whole nother supply channel for us. So that is very exciting, and especially with rates coming down, that helps us a lot as real estate investors and Mogul investors as a whole.
Yeah, that's super exciting. We're already seeing what would be, fully considered long-term rental investments that are tracking towards the, 8+% NOI yield, right? And so, $100 property, you have a $10, $8, let's say $8 NOI yield post expenses. You're taking out a, let's say $70 mortgage on that, and the rate on that is only 7% on that. And if you're beating that with 8% on your $100, that's accretive leverage, right? That's great for the investor. So the fact that these LTRs can continue to do that in a market like this, where rates are still at historic highs, people are renting. Like, obviously, the demand for renters is up very, very high, especially historically, just because the barriers to enter the buyer's market are very high right now. So I think we'll continue to see that even as rates continue to trickle down. But ultimately, yeah, like Michael said, this is great for us as real estate investors. It really opens up the market. It's also a major buyer's market right now, if I'm not mistaken. We've definitely been seeing a lot of good opportunity to enter in on some pretty significant discounts on the cost basis side. And the terms have been really strong in all of our purchase and sale agreements. Michael, is that right?
Yeah, absolutely. And then we'll jump into them in a little bit here, but our two most recent Airbnbs, we got them at a pretty steep discount to list, reflective of the buyer's market that we're in right now. So our plan of attack on the acquisition side is to fully take advantage of the market conditions and how it skews towards buyers right now.
Yeah, 100%. And what markets are we looking at? I guess in the nearer term, where do we have our eyes? I know the answer to this, but for our viewers, what are we kind of expecting here? Like on the the pad split side, I know everyone's super excited about pad splits right now. On the potential long-term and rental investment side, like what markets are kind of piquing our interest right now?
Yeah, absolutely. It's twofold. It's markets that we're already in that we want to expand further into, namely the Phoenixes, the Richmonds, and there's new markets as well that we're seeing a lot of positive data from the real estate market as a whole, but also how pad splits is performing and becoming more and more popular in these markets, and those being like in Nashville and Tampa, Florida. So you'll see us, not to give too much away, but you'll see us in the short term here start to penetrate more markets. Similarly, how on the Airbnb side, we just broke into Florida and Pennsylvania, two new markets that we haven't been in. So we have our eyes all across the board, and really are focusing in on some of the existing markets that we want to get even more assets in, and then net new markets for us that we're very bullish on.
Yeah. Maybe give everyone like a 30-second insight into what it's like for us to kind of dive into a new market in terms of like, getting to know the managers on the ground, getting to know the brokerage environment. It's actually really exciting stuff.
Yeah, absolutely. And specifically on the pad split side, we have very good relationships with the folks over at Pad Split who are very well connected in these pad split markets. So we connect with them. They give us intros to the top operators there for us to pick their brains. They give us intros to the top property management partners, so that we can interview a couple to see who's the best fit for Mogul and our investors. So yeah, it's a pretty extensive process. We don't just jump in blindly to any market or to any asset for that matter. But it's really tapping into the folks who are knowledgeable, boots on the ground in the market, and really just confirming some of the convictions that we have, seeing the market at a 10,000 foot view, compared to what the folks on the ground are saying about it.
Yeah, and that's also great because there's a lot of synergy there. And one of the cool thoughts that we saw from the reporters on Yahoo Finance in the interview was like, how do you guys make all this infrastructure work, right? Like, how do you make everything work behind the scenes where it truly is just a low physical touch, like one, virtual click to invest in real estate without all the headache of, the tenants calling at 4 a.m. and utility issues and all that, which we're familiar with dealing with initially through setup. But yeah, it's great that we don't have to pass those along to our investors. And the synergies that exist between the brokerage and management arms are great because when you're fully vertically integrated, like you have not only that knowledge of like transferring over from the managers who are doing all the groundwork and have the expertise in the market and can translate into the investment thesis on the brokerage side, but also the brokers who are then opening up that pipeline and are managing properties for potentially hundreds of operators already in the market, aware of us as buyers and kind of what we're looking for in terms of product. And so they can, pass along that buy box, find the opportunities that we're interested in, and then we can start working with them and having that kind of two-pronged approach on both the brokerage and the property management side. So it's really great stuff.
Right.
And huge shout out to you. Yeah.
And we see on properties that we launched, we put the details on each property page that most of them were offered exclusively to Mogul first in an off-market transaction. And that's, to your point, the relationships that we make with the brokers and the reputation we get in these markets as a quasi-institutional buyer that they know that are going to close on the deal, and they know what our buy box is. And it's nice to have those eyes and ears to the ground in these markets to pass us supply. And I mean, we turn down so many deals that just don't fit our box, but we get to look at it first before anyone else does. And that's pretty valuable. And that is a big value add that we provide to our investors, because it's opportunities that aren't listed on the MLS a lot of the time.
Yeah, 100%. And off-market deals are great. We love those. Obviously, incredible opportunity to get things at a lower basis, incredible opportunity to get a first look at things that are in our buy box, which is relatively competitive to what other investors might be looking for in terms of the actualized business plan, in terms of the yield requirements, sizes, location, et cetera. So great stuff. I see we're getting in a little bit of traffic on the Q&A side. So definitely keep dropping in your questions. We'll make sure that we leave time for Q&A as we're going through some of the major updates, and then also at the end. So please keep dropping in your questions. That's great. Maybe let's just quickly touch on, and the question that came in actually is pretty pertinent. Performance of the properties. We obviously just released dividends yesterday. Huge shout out to you and Sawyer as well for the three of us getting together, kind of making all of that infrastructure flow, and just getting those dividends out the door. I think it was again a great successful month across the board. We had 6 properties performing above a whole point for 1 month dividend payout, which is absolutely incredible. Most of the other properties were well within the underwriting guidelines, and then there were properties that were standard to kind of just normal Airbnb seasonality towards the slower months at the end of the year. You're going to see some of those shifts where you have lower average daily rates but relatively stronger occupancy, and so that's what we're kind of seeing right now. And I'm sure we'll get into more questions about that, but overall, really, really stellar performance. We're going to continue to be as transparent as possible, continue to operate in our business model and offer out those monthly touch points, answer all of your questions as they come in. We have an incredible customer service, or client service, as we like to call it, team here now. That's going to be great to just, kind of answer all of your questions, talk you through your investments. Really, really great stuff.
Yeah, we had a good month of dividends, mainly across the board. And to a term, Joey, that you just taught me a couple of weeks ago, is it the sinusoidal? Is this how we use that term?
Sinusoidal.
Real estate.
Exactly.
And it's important to always keep in mind with real estate investing, you do want to take a step back view of performance, and where month to month performance, especially on assets that have some seasonality to them, on the Airbnbs, or even sometimes on the pad split side too, there's seasonality that takes effect. So I just think it's always important to keep a full big picture view in mind when we analyze property performance. And like you said, it was pretty impressive how some of the top properties exceeding 1% cash yield this month. Just really exciting stuff to see that the portfolio is clicking at a good pace.
Yeah, I got to be honest, having my hand in a bunch of different cookie jars, so to speak, across the real estate industry, and having the past experience, you just really don't see a lot of that with stabilized assets at all. Normally in your more aggressive value add, maybe even opportunistic business plans, you're achieving what could be a percentage point of return each month, but straight net cash yield of above a point for a property that's fully stabilized and what would be considered like a core, maybe core plus asset is just a huge testament to the team, to the supply that we're offering, to the passive business model as well, to Airbnbs. It's a really, really great opportunity and a great hedge against kind of where the public equities markets are right now, right? If anyone is looking to kind of look for a safer, controllable, more private equity investment, real estate is obviously, the greatest wealth generator in the history of investments. So, that's how you do it. Yeah, it's been great.
Joey, do you want to cover a couple of these questions in the chat just before they get too bogged down?
Yeah, 100%.
Isaac's, where on the platform can I see returns of properties that I'm not investing in? I know that we are implementing a lot in terms of data and user-facing data on the platform. I know there's going to be more to come on that. Joey, is there anything that you want to add to that?
100%. Yeah, we're doing some revamps now to how your portfolio page shows. So in the portfolio page, obviously you can see your specific month by month performance of the properties, and then year to date performance as well, and all-time performance. We are aggregating a lot of our internal data now. Obviously, we're a relatively newer platform, so platforms like Arrived, who have been around for years and are just starting to release their actualized property earnings, right, which we always kind of reference to, and other platforms that are relatively lower to where we're performing now. But we're aggregating all that data so that way we will all have broader transparency into that. I will say, anecdotally, you can call in and when you go through your onboarding process, when you register and when you're talking to our reps, ultimately you can ask them about performances of the properties and they can walk you through, the underwriting tool, right, that we have online, which is tremendous also, and how that stacks up against where the properties have been actually performing. So would definitely urge you to use that tool as well, because you can actually sensitize what performance looks like according to what you think the property could be performing at regardless. And say you wanted to give, our conservative rents a further haircut of 10%, you can see exactly what that does to your return. So I would definitely urge you to check out those tools as well, but great question.
Yeah. And do we have a timeline on when the secondary market will be launched?
So we've been kind of advertising that the secondary launch will happen in 2026, and I think that we're still tracking. So the goal is to continue to build up the portfolio, make sure that all the infrastructure is there to provide that exchange, right, where you will get that instant liquidity, and we'll be able to facilitate a true and efficient market, right? Not one that's based off of speculation, but one that's based off of trading equity in your assets based off of the mark-to-market value on appraisals, rather than, say going on Robinhood, right, for example, and trading on equities, right? And then they make a fee, and whatever happens to your equity investment can go up or down according to how much is traded. That's not how that market would be treated. So we're working on getting all of that infrastructure in place, and we're still looking to launch in later 2026. So we'll keep everyone updated on that.
And do we have any long-term rentals currently? No, or will you in the future? Yeah, and that's kind of what we touched on earlier, is this lower rate environment, these new lending products that we've been presenting is opening the door for us to take on some long-term rentals, specifically in the small multifamily space. So more to come on that in terms of supply being brought online. Definitely something that we're starting to attack now. 1031 exchange. Can you 1031 into Mogul properties or out of them? Joey, do you want to take that one?
Yes, so it is. We've been working on a lot of the more legal barriers to enter on that side, and we have worked kind of around, or I guess into the ways that we can create it. There's a lot of different ways that we've discussed it in the past, where you can create, a Delaware statutory trust to do it as a larger group investment, or you could do it as more of an individual investment with specific control rights, that you would have. And so you'd be able to 1031 into a whole property investment that you'd be looking to make. So the capabilities are there. Yes, that is a possibility.
And is there a formula to help with the calculation of ROI or dividend payout based on investment amount? So yeah, we have exactly that on each property page. There's an investment calculator. You could type in a proposed investment amount. They'll show a line graph from year 0 all the way to year 10. That'll give you a snapshot of what anticipated returns are based on base case underwriting. And it also breaks out those returns, what's in the form of rents and what's in the form of property appreciation.
Yeah. And on my previous answer, by the way, for the 1031 exchange, just wanted to note, I wouldn't go into the platform and just do it and expect that you can submit the documents for 1031. Obviously, that needs to be done with proper title notice. So if you're interested in that, reach out to our team directly on the support, and we can help facilitate that.
Yeah. And another one, do you always perform a cost seg, or is it a case-by-case basis? And I believe the answer to that is it is a case-by-case basis, but each case is being reviewed by our CPA team to analyze when a cost seg makes sense or not on each individual asset.
That's exactly right. So we are this year performing cost segregation analysis on properties that do kind of, like Michael said, fall within the case-by-case review of our current CPA team. So stay tuned for that. But at the end of the year, obviously you'll get or going into the beginning of next year, you'll get your K1 forms for the calendar year 2025, the tax year 2025. So definitely stay tuned for that as well. We're starting to work on those so we can roll those out on time.
Cool. I'm going to try to quickly run through some of the remaining questions, and then we can hop back into some.
Yeah, and then we'll save the rest for Q&A
stuff. Any plans to launch mobile apps? I don't think at the moment, but it could be on the roadmap at some point in the future. Is that accurate to say, Joey?
That's definitely accurate. Yeah, definitely not a priority at the moment, but it definitely will be the case in the future.
And question, say your guys' website closes down, what happens to our money and properties? Joey, do you want to touch on that?
Yeah, great question. So there are a number of contingencies for every property at the property level, but ultimately, let's say the platform failed tomorrow. Essentially, you just wouldn't have the UI and UX to be performing kind of all of your portfolio analysis through the website itself, right? It would actually go into the trust management of the legal team that oversees the LLC, and then all the distributions would go out manually through email instead of through the platform. Is the direct high level answer.
Got it. All right.
The LLC would not be dissolved, and the property would continue to exist and continue to run as if the platform didn't exist. The platform is merely a conduit to manage and view your investments through. Perfect. Do we maybe want to save some of the Q? I know there's a lot of questions coming in, which is awesome.
Yeah.
To see this activity, but do you want to leave some time quickly to go through some of the recent STR launches, and then also a surprise that we have for all of our viewers here today?
Yeah, can you believe it? We have a surprise.
What could it be?
for the people that this is not your first webinar, you probably could anticipate something. That's something up our sleeve. So first, let's jump into the two new STRs that we've recently launched.
Perfect.
All righty. So we'll start with the Gruden. So super excited about this one. This is a already existing operational short-term rental in Largo, Florida, very close to Tampa, Clearwater. There's a lot to like about this, in addition to just the occupancy that it's had over the past 2.5, 3 years it's been operating. Very great on the amenities, pretty low upkeep, specifically on the outside of the property. There's no real yard that cuts down on the OpEx monthly. And Largo is one of the stronger short-term rental markets, not only in Florida, but across the whole country. That kind of Gulf Coast is a very attractive vacation area. And Largo has a lot of tourists coming through, and Tampa specifically is the major metro near there. And that's primarily where the biggest business hub in all of Florida is. Yeah,
no, it's great. And a great looking property, relatively large cost basis and great performance recently. And per usual, you can go in, view the comps. You can see the rental and sales comps, given this one's an Airbnb, which is great. And then you can go in to the property page here and, scroll down, and you can see exactly like what your investment will look like, very high level on the base, bull, and bear case scenarios per the investment size that Michael's highlighting now. And then, as we'll showcase when we go into our surprise later, we'll show you the calculators as well, which you can view. And we were talking about where you can actually play around with your own assumptions and your own estimates to see exactly what would happen to your investment if you wanted to stress test and kind of sensitize, a lot of the assumptions around operations, capital markets, et cetera. But yeah, incredible property. Definitely go check this one out. Really great work getting this one under contract and on the platform.
Yeah, and there was a question actually that I just saw come through, and it's applicable to address it. Aaron asked about, can you speak to any risks related to hurricanes, floods, and insurability on this property? So this property, we have extensive policies on. We have a homeowners policy. We have flood insurance. We also cover loss of use for a year's worth of rental income should anything happen to the property where we can't operate it. So we do cover all bases on the insurance side. And if in a nightmare scenario that a hurricane hits and there is a hurricane deductible that needs to be paid out for our insurance, we've actually capitalized an additional that nominal amount on the equity raise on the property to cover should we have to pay a hurricane deductible during our ownership. And it's important to note that the recent hurricane that did some damage to Tampa in the past year or so did not impact this property or require a deductible to be paid for hurricane insurance. But again, we always lead with a very conservative foot, and just how we capitalize this on the insurance side is an example of that.
Yeah, super well said. Awesome.
So we don't have to spend too much time on this one. We'll also jump to the Yamamoto, and then so that we can get to the surprise and the Q&A session.
Perfect.
So this is a short-term rental in the Poconos in Pennsylvania. For those of you that don't know, it's the eastern side of the state, and I'm from Pennsylvania, so I do know a little bit about the Poconos, but I'm on the west side out of Pittsburgh. But yeah, it's a very touristy area in terms of traffic that comes through. There's over 20 million people that live within a 2-hour drive from the Poconos. So you get folks coming from New York, and obviously Philly is nearby, and just really large metro hubs where folks go drive to the Poconos to vacation. And this property specifically saw 79% occupancy in the past 12 months, which is really unheard of on the STR side. And with that came very robust revenue as well. So this is one that we are super, super excited about. It's a tried and true business plan, kind of like what we aim to stick to on every new asset. And yeah, we're excited to kind of hop on a moving train in respects to this business that's been operating for a good 3.5 years.
Yeah, incredible stuff. And it looked great, and it's massive.
It's massive.
Forget how massive this one was.
Well, we already said, Joey, this might have to be the next corporate retreat location.
I know.
It's the Alcaraz in October, and then we'll see Yamamoto might be next.
Yeah, you don't have to tell me twice. That sounds awesome. Incredible stuff. Incredible stuff. Just want to make sure no other questions specific to these properties are coming in right now, and we will leave time for all of the Q&A, and we'll make sure we don't miss anyone's questions as we go into the end. Alex distracting. He said, will Mogul have a retreat at the Yamamoto in the future? There we go.
You tell us, Alex. I think you're the decision maker on that one.
That's hilarious. That's hilarious. Awesome. Do we get some discount on this Airbnb as investors? That's right. Yeah, definitely reach out. If you are an investor, we are more than happy to give you a significant discount on a stay at the properties themselves. We've actually been implementing some strategies too to give people that are tenants access to also potentially be investors in the properties, which is really exciting. So definitely reach out if you're an investor in a property and want to stay at it, especially on the short-term rental side. We will be more than happy to help.
Yeah, and just to elaborate on that, we're able to bypass any booking fees that Vrbo, Airbnb otherwise would charge. So by doing a direct booking, that saves you money when you stay there. And also, I think we have a couple ideas up our sleeves in terms of trying to ramp up occupancy through Mogul investors staying at properties, especially when it's approaching like a fire sale of 2 weeks away from the visiting date. We can give a steep discount because that would have been a vacant time period at that property. So there's many things where A, you'll benefit from staying at a Mogul property from a discount perspective, but B, as an investor in those properties, you'll benefit from increased occupancy from it.
Yeah, huge win-wins there. Awesome. Well, do we want to dive into the reveal so we can?
I think it's time. Let me switch my tab here.
Incredible.
All righty.
And please keep dropping in questions, everyone. I know we have not answered a few of them. We'll make sure we go through everyone in Q&A. That's why I want to make sure we leave time at the end so we can go through Q&A.
All right, so the drum roll, and here we are, our newest pad split in Houston.
Let's go.
Wabi Sabi. And if it looks familiar, that's because it's right next door to the Rock House. So this is just another ground up new construction in Houston, which we love the area. We also love the model of the ground up 10 bed, 10 ensuite baths. It's really a luxury product in terms of co-living out in the Houston market. So Really excited about this one, and we can kind of walk through high level some of the fundamentals on it and field any questions anyone might have. We have a decent bit of it raised so far, which is exciting, and it also just speaks to kind of the appetite that you all have for this type of product. So we're doing our best to keep acquiring more for you all.
100%. Yeah, we listen to your feedback, and we definitely tailor a lot of the pipeline towards what people are looking for. So, this continues to sell. We definitely want to continue to get incredible pad split opportunities, incredible STR opportunities, incredible, hopefully LTR opportunities, long-term rental opportunities here in the future. So definitely keep voicing your interests and keep investing towards what you want to invest in. But
I think we might have got a little. There we go.
Nice. Taking up.
Nice little bump.
Very nice. Very nice. Awesome.
Great. So
go
ahead.
Oh yeah. I don't want to cut you off, Mike. I was going to say you want to also take us through the analysis tab on this one, but you can continue to give the overview on the property as well. I don't want to skip out on that.
Yeah, absolutely. So getting this at a 635 purchase price, 75% loan to value, projected year one income right around 100K, which is a conservative mark based on the weekly rents per bedroom of this property. And what's nice is now that we have a couple of these under our belt, the market and comps support that 635 purchase price, and also supporting the rental income as well. We get a lot of data from pad split. So we get data not only from our existing portfolio of properties in the market that are pad splits, but also from pad split directly. We get insights into how the zip code performs in terms of average ramp up to 80% plus occupancy. What's the average weekly room rate for a shared bathroom with private bathrooms? So a lot, again, everything that we do is data driven, and the rents are evidence of that.
It's also really incredible to be able to kind of penetrate the midterm rental market in Texas. I know it's still actually relatively nascent in terms of specifically the pad split opportunities that are on there. I mean, co-living itself is obviously a tried and true business plan, but it's been great to be able to, work with lenders, appraisers to kind of figure out, a lot of the trials and tribulations that come with starting up new business plans and new markets. And we're having great success across Texas, and, obviously keep your eyes out for more Houston, Dallas, midterm rentals, and then STRs continue to be opportunities that we get across our desks all across Texas, including Austin, San Antonio. So definitely keep your eyes peeled. Texas has been really great.
Yeah, and it's in Houston specifically. I mean, there is such a dire need for affordable housing. I think the current affordable housing supply can 2x where it is right now and still not fully fill the need within that market, which just screams opportunity. And that's why we're excited to keep acquiring assets there.
100%. That's a great point. So
we'll hop to the analysis page on this one. I think I have to share it separately.
Awesome.
Okay.
Perfect. Yeah, as a reminder, this is the analysis tab tool that you'll see on your portal on the website in the top right there. Go check it out. You can see all of our existing properties. You can underwrite any property that you want. So if you type in an address on the analysis tab homepage, you can actually see any property that will have a starting underwriting, and then you can tweak the assumptions towards what you think the business plan will be, and save it and share it. So it's super exciting and really cool stuff. And we actually use this as our underwriting tool now, which is really cool, instead of good old trusty Excel.
Yeah. And you can even stress test against your own assumptions against ours for our portfolio as well. So that's what's great about this tool. Shout out to Aton for building it out and making it so interactive. We have, Jerry, do you want to touch on kind of the new feature that we implemented on putting in the strategy for each property and kind of how we're marking what strategy is which for each asset?
Yeah, absolutely. So typically you can segregate your real estate investments across 4 different business plans. And what it really does is it corresponds to risk, right? So you have core plus, value add, and then opportunistic are typically the 4 markers. People like to make up their own jargon for hybrids of different strategies, but ultimately it goes top to bottom in terms of risk, right? So your core investment is your kind of more stabilized investment, lower capex, relatively well-performing, tried and true business plan. You kind of know what's going to happen, right? And it typically has a relatively lower return threshold. So, people like to throw out different brackets, but what I've seen in the institutional world is typically anywhere from 4 to 7%. The fact that we're able to achieve yields, north of 7 to 8% on all of our assets, not just pad splits, but in year one is absolutely incredible and testament to the supply that we get. But that's typically what the core strategy invokes. And then when you're looking at core plus, take it one step further. Typically you're seeing anywhere from 10 to maybe 15% capex on initial investment that you have to put in on top of your purchase price to get things up and running. And that, again, those estimates go up and down according to, whether it's a single family rental, multifamily, potentially even like an institutional, office hotel deal, whatever it is. Those will swing a little bit, but, typically, 10 to 15, maybe 10 to 20% capex that you're putting into it to kind of get things up and running. It might not be fully stabilized. You have to take on some builder's risk, some stabilization risk, and then go through and ultimately implement the business plan. Value add is one step further. Typically you're seeing pretty heavy capex, pretty heavy recapitalization, renovation, repositioning of the business plan. And then opportunistic is a full-on, the riskiest investments, like full-on development deals, right? Full-on distressed assets that you're looking to completely pivot in 180 and create value that way. And that typically has the highest return threshold. And it really varies, anywhere from 15 to 20% plus on the IRR side from there. So that's kind of the overview. And you can see the strategies that we have assigned to each of our properties that come onto the platform in that upper left side of the bar. Yeah.
Joey's smart. If you didn't know already.
No, just real estate experience. That's it.
That's your experience on display. No, that was great. So just doing a quick walk down. So average yield 12.8%, annual return 13% IRR, a profit of a little over $400K over the hold term is what our base case underwriting projects. And starting rents, 8,400 monthly rents, growth rates marked at 3% on the rent side, also on the appreciation side, and doing a conservative mark of OPEX with property taxes, homeowners insurance, miscellaneous costs, your utilities, your routine maintenance monthly, property management fees baked in as well. And then we have a running growth rate on the expenses as well.
Perfect. And we did actually get a property specific question from Joe. Great to see you, Joe.
What's up, Joe?
So the question here is, why are the projected returns for the Wabi Sabi lower than those for the neighboring property, the Rock House? So, Michael, do you maybe just want to high level touch on the two material underwriting changes that we made on this one, and then we can talk through the broader implications?
Yeah. So namely, the two main switches were walking down the projected base case rents a little bit compared to the Rock House, and also taking down the appreciation 1% from 4 down to 3. And an overarching reason is we always want to provide base underwriting that we are confident in exceeding, as opposed to just really hoping that we can achieve. So that's part of the impetus behind adjusting, is because we want our motto to always be to under promise and over deliver on our assets, namely to their performance. But Joey, do you want to get a little bit more specific on the difference?
Yeah. So starting rents we took down slightly because this one only has 4 of the bedrooms currently occupied. There's time before we close, obviously, to get that fully stabilized, and it might be fully stabilized by the time we close. It might not. So it's good to bake in a lower starting rent compared to properties that have had higher stabilization rates in and around the Houston area as well when we close. And then on the appreciation side, to echo kind of what Michael's saying, on pad splits specifically, I think it's really important to make sure that you're not following the rest of capital market sentiment all the time when you're looking at single family rental, prices for first time eager home buyers are up 6% year over year in this market. It's like, that's a great generalization. But in terms of the capital markets treatment of these pad splits, they're stabilized operating businesses, right? And so, they're very much valued off of cash flow potential rather than, trading sales comps potential, right? Like a normal single family rental. So when you're looking at the cash flow, like growth here, you're going to want to make sure that your capital markets treatment of that growth through, say, a 10-year hold is directly attributed to kind of where you see the growth here. So the fact that we took down starting rents here, the fact that we're being a little bit more realistic about where these rents might grow to in the future, it would only be appropriate to also treat the capital markets treatment the same. So it's a great question. The Rock House, we did show 4%. Will 4% be achieved by the capital markets treatment of the properties and that growth over the next 10 years? Probably. It very well might be. The base case is, typically, 2 to 4%, right? So anywhere in there is realistic to expect. And as Michael mentioned, it's going to be very sinusoidal, right? So you're going to see, maybe a 6% jump in year one. You might see a 3% dive in year two, and then you might see another 4% hike in year three. And with the volatility of the market right now, I don't think anyone can confidently say what, next year's appreciation is going to be on these assets. So that's what we're thinking, open and honest, full transparency into kind of where we're looking at our risk underwriting and kind of what we're comfortable showing. So yeah, to echo Michael's sentiments, I think that's exactly what we're looking for.
Yeah, it's interesting what we are finding out about the pad splits specifically is, and I guess you wouldn't know it unless you're in the day-to-day of it, but the culture of a house has such an important influence on occupancy and sticky tenants that stay for a long time. So whenever you launch a net new pad split, it can take a little bit for the asset to gain its footing, and specifically around the culture of the house and the occupancy ramping up and staying high in the 90% plus. So just interesting learnings as we, grow out the pad split portfolio, and, we do everything we can on our side, same with our property management partners, to try to, have a positive impact on that house culture and ramp up occupancy.
100%. And Azam asked, can you please explain the difference between average yield versus annual return while we're on this? So the difference is that the yield is strictly the cash flow, right? Whereas the annual return takes into account the growth of the property's value through the hold. So if you go to the top real quick, Michael, or actually maybe if you go to the bottom so we can see the levered cash flows, just full transparency, and we won't bore people with the specifics. But, walking down the cash flows here, you can see the levered cash on cash yield there is the net dollars that you're getting. And that percentage is a direct reflection of the dollars that are being paid out each year on top of the total equity dollars that are invested to buy this deal, right? So that doesn't include the mortgage dollars. It includes all the dollars past the mortgage dollars that it takes to fully capitalize this deal. And that's the percentage yields that you're getting on that. The levered return there, the IRR, that is a time valued metric of how your money grows. So it's actually a compounding metric over what we underwrite as a 10-year hold and what you can change from a timeline perspective at the top there on the hold. And that levered IRR shows you the compounding growth of your dollar through the entire hold of the asset. And that takes into account the drag of time that it takes to achieve that return, right? So that 13% annualized year over year return over that 10-year hold, including the exit, right, of when it's, achieved its growth in however many years. So that's underwriting it on the asset level, right? When you're looking at like what your individual investment looks like, it really depends on how long you've been holding the asset specifically. Like if you sell it on the secondary exchange after 3 years, you're actually going to be selling it at a basis that was achieved between that year 0 and that year 10 value that we're projecting for this IRR in there. So you'll have a very specific return and say that you achieved 6% growth in that year 1, like I said, 3% dip in year 2, and like 4% growth in year 3, and then you sell, you're getting a 5% net growth on your capital on top of the yield that you've already achieved. And so that's what that IRR represents. In a nutshell, that's what that means.
I think we got a decent amount of investment in the past 10 minutes or so. Wow, 140, almost 144. That's awesome. And I think it's also important to note that the cash yield at the end of the year, the rental income that you receive is tax advantaged. So it very well could be once that K1 comes for year end, it's 0 or close to a net loss for reporting purposes. So this, again, the tax code is written to invest in real estate. And when you do it through Mogul, you do get all those same tax benefits as if you went and bought an investment property on your own. It's all the same pass-through tax benefits.
100%. Do we maybe want to make sure that we leave enough time here to go through the rest of the questions? I can just start rattling them off.
Absolutely.
Awesome. So Dennis asked, do we follow a standard playbook? Michael, do you want to just give like a 2-second overview of kind of our buy box in general?
Let's see. I think the second part of his question was about the playbook on the cost seg.
Oh, got it. That was
earlier.
Oh, okay. Yep. Perfect. Awesome. So we already answered that. And then we answered Trinae's question on both the calculator, I believe, and looking at what happens to your investment dollars. Michael's question is differences noted between passport occupancy. Pad split, not passport. Then he's corrected himself. Yeah, on the website versus stated expected occupancies on Mogul. Can you explain the difference or expected changes that you're anticipating to increase those occupancy rates? So I believe he's referring to the market reports, right, on pad split that we're seeing, where like we actually have been seeing like relatively lower occupancy, and we were exploring that with Aaron the other day. Do you maybe just want to quickly touch on that, Michael?
Yeah, I mean, part of our underwriting is leaning on those market insights that are public facing. So that does guide us in our underwriting, but also when we're taking over an existing pad split, we're getting audited actuals on the financials in terms of rental income received from the past 12, 24 months. And again, those are audited against from pad split. So we're getting the true income. So that is more of a guide on how we underwrite these properties, because what we find is some of the data that is provided on pad split side, if it's a zip code that shows a 74% average occupancy, there could just be a couple bad operators within that zip code that's completely weighing down the metrics on that zip code. So it doesn't tell the true story of how this new pad split will perform. So we do take it into account with how we underwrite our deals, but we really lean more towards the actuals because, again, it's tried and true. And it's an indication of how the property will perform based off of how it has.
Yeah, spot on. Chris asked, are the growth rates used for appreciation and rental income underwriting based on national local sources? I think, yeah, Michael kind of just touched on that, right? So we're constantly monitoring macro data, right, from all of our kind of trusted sources, but also we're talking to our managers on boots on the ground, making sure we're understanding what's happening in each micro location and each submarket. So that way we can have, deeper insights than just what, a macro report would say for, a zip code or a city. But yeah, great question. Can you speak, Andrew asked, can you speak how frequently new properties are brought to the platform for investment? Is commercial real estate something you're looking at or considering? Why or why not? So right now our cadence is typically 1 to 2 properties per week. We do see that increasing kind of going into next year. And in terms of commercial real estate, we're definitely not interested in right now, at least, in like anything that would be considered office or, hospitality or, data centers or whatever it is that's more institutional commercial right now. We are focused on single family rentals and ultimately scaling up into, higher density rentals. Like Michael was saying, now we have the capabilities to actually go after kind of 4 unit plus 4 to 10 unit, high density kind of long-term rental, maybe even midterm rental units that could be considered, multifamily, I guess, if you look at it from a commercial perspective. So that's kind of something that we're looking at now, and you should be able to see launching, relatively soon. We're really excited about it. In terms of why, I would say that it's just like, it's kind of not what we're looking to compete in. We always talk about being able to compete in the single family rental space. You're a fish in a very large pond. It doesn't really matter how big or small you are. When you're talking about competing for, the next Class A office building or hospitality building, there's only a very select few that get to be able to participate in those buyer interviews and ultimately get considered to purchase those assets. Not to say we couldn't be those buyers in the future or very near future potentially, but it's just not something that we look to facilitate. Also, the return profiles are very, very different. So, if you're looking for a kind of, 8 to 10% cash yield, 7 to 10% cash yield, starting with an institutional investment probably isn't the way to go, especially when you're looking at retail investment check sizes, but it could happen in the future. So that's kind of just an update for now. value add opportunities. Michael, you want to take this one?
Yeah, I think to date there hasn't been. That hasn't been part of our acquisition strategy. I think as we go into 2026, we are going to broaden our horizons in terms of the type of assets and the type of business plans that we attack. So that's definitely something that we've talked about internally, and you might be able to see at some point in 2026. There's 10 minutes left, so some of these questions we'll just like rapid fire.
Yeah, let's just wrap.
Just for the sake of time that we have. But Isaac, some of the pad splits seem to be custom built for multi-tenant use. Does that create resale risk? In one hand, it does, because people aren't going to buy these to be their single-family primary residence. But there's also a very wide market of real estate investors and a very large pool of buyers in that regard on the investment side. So while it's never going to be someone's single tenant primary residence, I believe, especially in the markets that we target, there's always going to be a pretty large buyer pool for the type of assets that these ground up new constructions are.
100%. Yeah, it's very accurate. If I invest for my IRA, Dan asked, how are my funds transferred to Mogul such that they remain protected for tax purposes regarding IRAs? So yeah, Michael, unless you want to step in, we do have entity investing capabilities, Dan. So if you are investing through your IRA, we'll walk you through that process when you're either going through your registration or if you want to reach out directly, we can walk you through that entity investing process. And then I think we got through some others. Aaron had asked about the hurricane risk when we were talking to Yeah, we talked about those. And then we talked about the flood zone, which is great.
Touched on the discount of Airbnbs.
Yep. Talked about underwriting. And then it looks like Azam asked another question. Is there any way to compensate this investment tax benefits against W-2 income? I understand you are not CPAs, but anything you can suggest based on your experience, cost segregation. So the K1s, right, with the as a pass-through entity, you do get the benefits of any accelerated and just straight line depreciation, depending on the analysis, pro rata according to your ownership through that K1. So it depends on what your income is. Like if it's just standard W-2 income from your full-time, W-2 job, you likely won't be able to directly offset that. But if you are performing, say, property management services, it doesn't have to be specifically property management services, but if you have other sources of income or investment income that you can offset with the K1 distribution forms, then that will actually directly help offset those. But I hope that answers your question directly. Janet says, when do our taxes, when will you tell us how to enter the info? Do we need to have an LLC to enter the K1? No, so you just file it with your tax filings. Like if you're doing it through TurboTax or with the CPA, you'll just file that. You say, I have a real estate investment. Here's the K1 form for the real estate investment or investments. And then they'll take it into account with your return. Our K1's only federal. So you just file it with the tax return, right? Like with your federal return. And then obviously your state return is just dependent on if you have to file a state return or what state you're living in. Can you expand on the investment offset? So if you have income from other investments or investment related activities, that's how you can offset those income distributions with the K1 straight line depreciation that's coming through to help offset that income. That's how that typically works.
Yeah, and I guess like a very high level to look at it, to explain it, is if your equity position in property A yields you $1,000 of rental income throughout the year, come tax time, your K1 very well might say zero taxable income or negative taxable income, so a net loss for reporting purposes. And that K1 is fully packaged and landed to you, uploaded to your account on platform.
Right. Yeah, exactly. So there's the dollars that you're actually getting distributed, like from the Mogul platform, which the depreciation will offset, and there's potential additional offset, but that's exactly right. So the dollars that you're getting distributed should be fully offset on a property by property basis as well by that depreciation benefit. Exactly right. Awesome. And then I think we got a question too in the questions tab. Is the Wabi Sabi Invest tab active by email? I don't see it sent out or on site. So we have included the link here. Thomas,
Thomas, do you want to resend the link?
Yeah, we can resend the chat link here. Yeah, of course, Dennis, appreciate you. There it is. So that's the direct link to the Wabi Sabi there. And then you asked, do we have any specific CPA recommendations? Again, we can't really, recommend that you use any specific CPA. It depends on your situation, from personal experience. I think if you have, again, multiple investments and you have a complex tax return, it's probably more beneficial to use an more individual client service CPA rather than just like a scalable TurboTax, for example. But that's just my 2 cents. I don't know, Michael, if you have any thoughts on that.
No, that's it. No financial advice.
Yeah, exactly. You've been trained well.
Correct. Yeah, right. It's the lashings Alex would give me during training. A single K1 for each LLC. Yeah, that's right, Dan. You'll get a K1 for every LLC, each property.
Awesome. We did it. We rattled through. Just want to make sure we, in case anyone else had, okay, so it looks like a couple more coming in. Well, we receive the K1s timely. I receive a lot of K1s each year, but I have to file an extension each year because some K1s trickle in after April. Yeah, so that's totally fair, Victor. Yeah, I mean, we'll make sure we have them out on time, so we hopefully don't have to deal with any extensions. I had to file an extension as well personally, just because of things like that. So can definitely relate, but our goal is to definitely get them out on time. So awesome. Well, we have a couple minutes left here for any additional questions. And then Michael, if you have any parting thoughts or anything you wanted to mention, any shout outs or roasts that you would like to give to the team or otherwise, now's the time.
Yeah, there's some roasts I might not be able to do on a public forum. Yeah, no, shout out. We got some new team members over the past couple months that are absolutely killing it and really are putting us in a great position to scale, especially going into 2026. So Sawyer, John, Larry, all you guys are killing it, and Ryan as well on the dev side. So definitely keep it up. And Joey, if I forgot anyone there, please help me out.
No, that's great. And then, obviously really appreciate Alex, Thomas, everyone's doing a great job. So continue to rock and roll. And really, really enjoyed this session. Oh, it looks like maybe one more question. How large is the team now? So we're up to about 8 or 9 full-time FTE employees here. And then we have a bunch of contractors as well that we work with, and then partners, that we're contracted with separately. So the team is definitely growing, and you'll continue to see growth in the portfolio and the assets that we're releasing, and some really, really cool feature updates that we're future updates that we're looking to release here shortly. So definitely exciting.
One thing to note is any suggestions that you all have as a user, as a consumer of the product, if there's any features that you would like to see, that's how a lot of our product enhancements occur, is based off users' feedback. So definitely relay any suggestions you have to us. We're all ears.
Absolutely. We got an interesting one from Noah. One more cue. What are your thoughts on Arrive's $27 million funding to build out a secondary market? Interesting. I actually wasn't aware that they're building out a full secondary exchange. I'm curious to see how that works and what that looks like. I
think Eitan and Ryan can do it for less than 27.
That's a great response. I mean, ultimately, I wonder how much of that capital too is just allocated towards pools of liquidity and or deposits for credit vehicles that are used for the liquidity. Secondary markets are really complex things. Ultimately, they're easy to kind of explain, but the math behind them, and again, making sure they're efficient, judging how assets are marked to market and what you're trading on, the volume, the fees, it's all a lot to take into account. So very interesting. We'll definitely look into that more. Dan quickly asked, are you gonna have another round of raising funds for Mogul? So we did just have a successful raise earlier this year. We are growing really quickly. We will stay tuned. We'll think about doing a raise here in the near term future, but things are going really, really well. Brad, yes, we did launch that property live. You can see Thomas dropped it here in the chat. Maybe we can drop it one more time, but exciting stuff. Could you add the info on each property when income will come in, dividends? Yeah, so you can see the first month's anticipated payout on dividends, Janet, if you go into the property. But yeah, I would definitely
Brad,
go check.
no more properties tonight, Brad, but maybe in the next couple of days, it might be I might have put a couple Easter eggs in the webinar about what's coming up next in our pipeline. So I'll let you all run to your conclusions on it, but stay tuned over the next handful of days. We might see a new asset come on.
Someone named Alex says he likes Michael as a host. I like him too. I like him too.
I like that guy, Alex. He's
I like the
good head on his shoulders, it seems.
It seems.
Good judge of character.
Awesome. Well, we are at time. We want to make sure that we hold true to giving everyone's time sacred here, and really appreciate everyone showing up, and we'll continue to provide some awesome updates, and we'll see you next month.
Yeah. Thank you all.
Awesome. Thanks, everyone. Appreciate you.